After months of euphoria around railway stocks, investors finally seem to be pulling away from the sector. Does that make you wonder if the railway stocks could nosedive here on? Well, such euphoric market conditions typically end up in a bubble. Question is, when could the bubble pop? More importantly, not every bubble is clearly visible. The economy of Iceland was not the most obvious bubble in 2008. During the mid-2000s, it went from being an Arctic backwater that specialized in fishing and aluminium smelting to a global financial hub. But the transformation went largely unnoticed. Iceland's three biggest banks grew to 10 times the size of the economy by offering overseas investors higher interest rates than they could get at home. Then, armed with this cash, Iceland's bankers went on an asset buying spree. They bought foreign companies, real estate, and even foreign soccer teams. Iceland's banks were not only paying prices for questionable assets, they were also promising to pay their depositors high interest rates. This was about as sustainable as a business model can get. It wasn't that hard to tell, but no one raised an eyebrow until the global financial crisis of 2008, and that unfolded in the US. All three of the Iceland's major privately owned commercial banks defaulted in late 2008. This, relative to the size of the Iceland's economy, was the largest systemic banking collapse in economic history. So while the world stayed focused on the collapse of Bear Stearns, Lehman Brothers and the US crash, Icelandic financial crisis was no less. But it was quickly forgotten thanks to its relatively small size. Similarly, there are sectors and companies today which are brewing excesses that could eventually lead to a crash, both in the business and stock price performance. Could railway stocks be amongst them? Now, the railway stocks euphoria is largely backed by the rupees 2.4 trillion capex outlay by 2030. There are several parts to this mega capex trend. The Railway Ministry has finalized the largest acquisition of 75,000 wagons over the next 3 years. In addition, the government is considering introducing nearly 80 new Vande Bharat trains. To add to that, there is a plan to revamp almost 200 major stations around the country. So needless to say that a bunch of railway companies, most of which are now listed, are winning orders at a pace never seen before. The news headlines on the railway capex plans have kept investors hooked to the railway stocks for months. But most of the railway stocks are very different from each other. What is common amongst them is the certainty of growth in order book and certainty of revenue from their single customer, the government. This has allowed several railway PSUs to have business models that are both lean and profitable. Let's consider three of the most sound railway stocks. Take the case of RITES, RITES, which is primarily a consultancy company which gets guaranteed consulting assignment business from dozens of customers in India. Thanks to its affiliation with the government, selling its services is not a problem. Indeed, in many projects of a strategic nature, the government does not want to trust a non-government entity. For example, when integrated checkposts are required to be built on borders with neighboring countries like Pakistan, Nepal, Bangladesh and Myanmar, the government prefers to only deal with entities controlled by it. RITES does not have to undertake risks relating to the land acquisition, funding, getting paid by toll bridges and road customers or power plants, etc. For turnkey projects of Indian Railways, it gets paid in advance. Similarly, IRFC is a systemically important NBFC, which ironically has neither funding risk nor credit risk. It is a dedicated market borrowing arm for the Indian Railways. So, the primary business of IRFC is the financing of the acquisition of rolling stock, which is locomotives, carriages, wagons, etc. for Indian Railways, as well as providing funding for its other infrastructure assets. IRFC does this by borrowing money from the debt markets for investing in rolling stocks and infrastructure projects sanctioned by the Indian Railways. It then leases these assets to railways at an effective yield at just a little above its cost of borrowing. In effect, IRFC is like a bank having just one customer who is supposed to guarantee IRFC's profitability. More importantly, since the quality of assets on IRFC's books are guaranteed by the government, the company must neither make provisions for bad loans or NPAs, and it does not have to worry about the credit or funding risk. The third entity, IRCTC, is the only entity authorized by Indian Railways to offer online railway tickets. The company charges convenience fees in the range of 15 to 30 rupees per ticket. It is also the only entity authorized to manage catering services on trains and major static units at railway stations. The company also enjoys a monopoly in packaged drinking water at railway stations. It is the only entity authorized by the Ministry of Railways to manufacture and distribute packaged drinking water at all railway stations and trains under the Rail Need brand. IRCTC has seen a sharp jump in online ticketing volumes over the past decade. Having a monopoly in railway ticketing, it fetches operating margins as high as 80% compared to barely 10 and 20% margins in the catering and packaged water business. Thus, these are few railway stocks that sport excellent fundamentals thanks to their unique positioning and strong government backing. Above all, it is the lack of competition from their private sector peers that has kept their financials impressive. Therefore, any signs of competition could become a huge valuation risk for these stocks. Compared to other railway stocks, these three are certainly less vulnerable to destruction of shareholder wealth, especially when held for the long term. However, just like the Icelandic bubble, there could be several pockets of bubbles in the Indian stock markets waiting to burst. Do check out the comparative financials of the best railway stocks on the Equitymaster screener. Hope you like this video. Thanks for watching.